Okay, let's talk about your money. What if you could stop just, saving it and actually start making it work like a bank's money does? Today, we are diving deep into the world of peer-to-peer lending. We're going to break down the playbook for how you can, essentially, become the bank.
Seriously, think about it for a second. Right now, your money's probably sitting in a savings account earning, a tiny fraction of a percent? But what if it could be out there, working for you, pulling in real interest income, the same way a bank's money does? That's the huge idea we're going to unpack. All right, so how on earth is this even possible? Well, it all comes down to one really powerful idea: cutting out the middleman.
You know the old way, right? It's simple. You put your money in a bank, the bank lends it out to someone who needs a loan, and who keeps most of the profit? The bank, of course. They get the lion's share. Well, the P2P model just completely flips that on its head. It creates a direct line from you, the lender, to the borrower. And when that middleman is gone, guess where the profit goes? Right back to you.
So this whole thing, this direct connection, it's all handled through online platforms. You've probably heard of some, like Prosper or Lending Club. You can think of them as the marketplace. They do the heavy lifting. They check out the borrowers, they handle all the payments, all the logistics. Basically, they give you the toolbox to step in and act as the lender.
All right, so the concept sounds awesome, right? But look, with any investment that offers real returns, there's always risk involved. And I gotta tell you, understanding how to manage that risk isn't just important, it is the single most critical piece of this entire puzzle.
So what's the big bad wolf here? The main risk has a name. It's called default risk. And it's actually pretty simple. It's just the chance that someone you lend money to, can't pay it back. If they default, you could lose the cash you put into that specific loan. So the big question is, how do we solve for that?
Okay, first things first, let's talk about what not to do. This is probably the biggest, most dangerous mistake people make: taking all their money, say $5,000, and putting it all into one single loan. I mean, think about it. If that one person defaults, your entire investment takes a massive, maybe even a catastrophic hit. It's just not worth it.
So what's the solution to this giant risk? Well, it's actually surprisingly small. $25. That's it. This number right here is your secret weapon. See, these platforms let you invest as little as $25 in a single loan, and that tiny little minimum, it changes everything.
Because now, instead of that one scary all-or-nothing loan, you can make 200 tiny little loans of just $25 each. This is what we call hyper-diversification. And now, think about it. If one of those 200 people defaults, who cares? It's a tiny little dent. The interest payments you're getting from the other 199 successful loans will more than cover that small loss, and then some. It's the power of numbers.
Okay, so we've got the big idea and the number one rule down. Now let's get practical. Here is a super simple 5-step playbook to put this whole thing into action, and the best part is, it's mostly on autopilot. Honestly, the process itself is surprisingly straightforward. You pick a good platform, you put some money in your account, and then, and this is the magic part, you set your rules. From there, you just flip on the automation switch and let the system do the work. The whole goal here is to make this a passive, set it and forget it kind of strategy.
And I really want to hammer this home, that step 3 is where you become the brains of the operation. This isn't about you sitting there scrolling through hundreds of loans trying to pick winners one by one. No way. Instead, you're just telling the platform's automated tool exactly what kind of loans you're willing to fund.
And here's one of the main ways you do that. The platforms grade every single loan based on the borrower's credit history and risk. So you've got AA loans, these are the safest, lowest risk, but they also pay the lowest interest. And as you go down the list to something like HR for higher risk, the potential interest rate you can earn shoots up, but of course, so does the chance of default. You get to be the boss. You decide the exact mix of these risk grades you want in your portfolio.
Okay, last part. Look, knowing the rules is great, but knowing what not to do, knowing the pitfalls, that's what's going to make you successful in the long run. So let's quickly cover the 3 most common mistakes people make.
First one, and I feel like a broken record, but I have to say it again, not diversifying enough. It is the #1 mistake. If you have less than 100 or 200 different loan pieces, you're just taking on way too much unnecessary risk. Second, what we call reaching for yield. That's when you get tempted by those super high interest rates and you only buy the riskiest loans. It's a recipe for trouble. And finally, just forgetting about taxes. Remember, the interest you earn is income, and the tax man's gonna want his cut. And this quote right here, it really just sums up the whole philosophy.
It's so tempting to chase the biggest, highest returns, but a balanced, predictable portfolio that's spread across all the different risk grades is just way safer, and honestly, it's what wins in the long run. You gotta think of it like building a solid foundation, not buying lottery tickets.
So look, when you put it all together, cutting out the middleman, totally embracing diversification, and using automation to your advantage, you can build a portfolio that really does act like your own little bank. The playbook is right here. The only question left is, are you ready to build yours?